All right, so today I'm going to talk about how to analyze a stock. We're going to try and go through the most straightforward cookie cutter way to get the point across, skipping a lot of nuances, but ideally hitting the points that we really need to. All right, so the stock we're going to do the fundamental analysis on is going to be Meta. So I'm going to plug this in, Meta Investor Relations. So once you've opened up Meta Investor Relations, you're going to go to Financials. For the sake of this example, we're not going to do quarterly earnings. We're going to do the annual report, which is going to show year-over-year comparisons of the company's earnings, and that's the way we're going to assess it, essentially to get a zoomed out picture of what this company's earnings have looked like over time for long-term investors. So I click SEC filings. It's going to bring me down here. I have it on 2025 because I want the latest version. Have it on annual filings. I'm going to click PDF. Now that I have PDF pulled up, I'm going to go to page 3, table of contents. So we have financial statements and supplementary data. We're looking for the financial statements. So that is on page 81. So you can see here, consolidated balance sheets, consolidated statements of income. I'm looking for consolidated statements of income. So it says that's on page 87. Here it is on page 88. We have the income statement pulled up. What I'm gonna go ahead and do is start comparing revenue year over year. So 2025 hasn't ended for Meta. That's why we don't have the 2025 number here, but it's their latest report in 2025 and it shows the previous few years, 2024, 2023, and 2022. So revenue is considered your top line. People will talk about top line versus bottom line growth. Your top line is your revenue. How much did the revenue grow? That is before any expenses. Then bottom line is your net income. Come down to net income here. This is your bottom line growth. So something super important to remember. Revenue being top line, net income being bottom line after all expenses, including taxes. So I'm going to pull out my calculator. So I'm going to do 164,501. I'm going to divide that by 134,902 equals 1.219%. So 22% year-over-year revenue growth. Exceptional for a company of this size. So then I'm going to go ahead and do 134,902 divided by 116,609, and that is 1.156%, so about 16% revenue growth from 2022 to 2023. So that's the simple way to check how much a company's revenue has been growing year over year. Super straightforward. So that's just revenue. That's your top line. And when people are talking about analyzing a company's growth, they're going to be talking about typically their revenue growth. And then beyond that, they're going to be talking about their net income growth. Now, your revenue growth relative to your expense growth is going to dictate whether or not your net income growth is very fast or not. So if you're growing revenue 20%, 30%, and you're growing your expenses 10 to 15%, then that is going to be an instance where your net income is going to go up substantially more than if you were growing revenue 20% and growing your expenses 20%. That would result in a much lower net income growth number. We'll get to the nuances of net income later though. So now we're going to calculate total cost and expenses, see what that grew at. So we're going to do 95,121 divided by 88,151. That equals 1.079%. So 8% expense growth from 2023 to 2024. Now we're going to do the comparison from 2023 to 2022. So 88,151 divided by 87,665. So from 2022 to 2023, Meta didn't grow their expenses by a single percent. They grew their expenses by 0.5%. This 87 billion to the 88 billion in expenses. Very minimal. Okay, moving on. Now we're gonna go ahead and compare the 62 billion in 2024 versus the 39 billion in 2023. So same concept. 62,360 divided by 39,098. So they grew their net income 60%, about 59%. So Meta grew their net income by 60% from 2023 to 2024, which is remarkable growth. All right, let's see from 2023 to 2022. So 39,098 divided by 23,200. So they grew their net income 68% from 2022 to 2023, another exceptional number. So that is the difference between your top line growth and your bottom line growth. Now, growth is great if you're growing your net income. Now, if you're growing for the sake of growing without any profitability and you're spending substantially more than the amount you're growing, then you're going to have declining net incomes. Whereas for this example with Meta, they had 15 to 20% revenue growth and about 1 to 8% expense growth, resulting in that explosive double-digit net income growth level on the bottom line. Now, if we pull up Meta here, just look up Meta stock, not meat stock, Meta stock. So we check out Meta here. It has a PE ratio, a price to earnings ratio, which is a nuance we're not going to get into right now, but it's the amount they trade times their earnings. So Meta makes a certain amount of money, they have a certain amount of shares, and they trade a certain multiple times that earnings. It's complicated, we won't get into that, but that is a nuance to understand. So what I'm going to do here is take this 26 PE ratio and compare it to the latest growth we had in the last quarter, or the last year in 2024. So again, we're going to go through this. Their net income from 2024 to 2023, they grew 62,360 divided by 39,098. So they grew their net income 60% just about, and that was from 2023 to 2024. Now their PE ratio currently is 26. So now getting into a more nuanced subject, which is a PEG ratio analysis, which is your price to earnings ratio relative to your growth. Another nuance we won't really be getting into, but it's a way of assessing whether or not a company is overvalued or undervalued. And the concept goes like this. If you take your PE ratio, the multiple you trade times your earnings, and you divide it by your net income, your bottom line growth rate, and it is 1, if it equals 1, the stock you're buying would be considered a fair deal. Not undervalued, not overvalued, just fair. Now, if it were under 1, it would be considered cheap. If it were over 1, it would be considered a little expensive. So if their PE is 26, the price to earnings ratio divided by their growth rate on the bottom line, which is 60, it would equal 0.43. So Meta trades at half of a 1 peg. A 1 would be considered fair. So you could make the argument that Meta is 50% lower than it should be. Now, what would 50% on top of Meta look like right now? It would look like a $1,200 stock. Now, they would obviously have to maintain that growth rate to be able to justify that PE ratio, but that is the simple way to look at an income statement, analyze whether a stock is doing well or not, just simply how to read what is their revenue, what is the money that's coming in, what's going out, and then what is it after taxes. And obviously, if they're making more and more profit each year, 60% growth over a couple year span, that's a super positive thing. Now, we didn't dive into balance sheet here, but balance sheet is absolutely important as well. So when it comes to balance sheet, I'm not really going to get into this, at least not in this video, but I would just take a look at their total assets. So they have $276 billion as of 2024, and their total liabilities are $93 billion. So their asset to liability ratio is like 1 to 3, because 9 times 3 is 27. And so that would be, quite exactly 3 to 1 ratio. A 1 to 1 ratio is considered good. A 2 to 1 ratio is considered great. 3 to 1 ratio is fantastic. So we didn't really get deep into assets versus liabilities, but super important as well. Even if a company is growing super fast and the revenue and net income growth is solid and they don't have extreme expenses, what are they doing with their money? Are they, are they overspending on capital expenses, or, do they have a load of debt that is costing them a lot of interest expenses? Those are all important things to consider, because you want your company to survive hard times. If a company goes through a recession, you're going to want to know that they have enough cash to endure it. They have more assets than they do liabilities, and they can sustain bad times if things aren't going well for them. So that is a super straightforward beginner level analysis on income statement, balance sheet, not really getting too much into the nitty gritty with the balance sheet. But yeah, hope that's helpful, and maybe make a next one soon.